Here's what most people do with their first $1,000 to invest. They wait. They wait until they know more, or until the market looks better, or until they feel ready. That decision right there is the most expensive mistake a young investor can make. $1,000 invested at 22 at the S&P 500's historical average return of 10% grows to approximately $60,000 by retirement. The same $1,000 invested at 32, $23,000. Same money, same investment. 1 decade later, $37,000 gone. Not lost to bad decisions, not lost to fees, lost to waiting. If you have $1,000 right now, or you're working toward it, and you don't know exactly what to do with it when you get there, this video is built for you. Step by step, in order. Let's get it. In previous videos, we covered why investing matters and what compound interest does to your money over time. We covered the Roth IRA, the tax-free account that turns your investments into generational wealth. We covered index funds and why they beat 90% of professional investors in exactly which ones to buy. Today, we're answering the question every single person asks. Okay, I have money. What do I actually do with it right now? The answer is simpler than you think, but the order matters. Before we get to what to do, let's talk about what not to do. Because the 3 most common first moves beginners make are the 3 most expensive ones. Mistake number 1, investing before you have an emergency fund. I myself am guilty of this. I've done this in the past. When I first started investing, I did not have an emergency fund. Well, one thing led to another. Life happens. I was forced to liquidate my investment accounts because I did not have an emergency fund. It was an expensive lesson, but eventually I learned. So, number 1, emergency fund. This is the most common one, and it derails more new investors than anything else. And here's why it matters. If you invest $1,000 and then your car breaks down, you're either pulling that money out of the market early or you're going into debt. Either way, you lose. Financial advisors and Fidelity specifically recommend having 3 to 6 months of essential expenses saved in a liquid account before you invest $1. That doesn't mean a savings account loaded with 12 months of rent money. It means a realistic cushion. Your rent or mortgage, groceries, utilities, insurance, anything that you spend on a regular basis, you need to have at least 3 to 6 months of that. I'm fortunate enough to have 1 year. I do not touch it. I keep it in a high yield savings account. We'll talk about this later down the road. Hopefully I never need it, but it's there if I do. But if you don't have an emergency fund yet, that's step 0. Start there before you invest a single dollar. Quick pause real quick. If this series is useful to you, hit subscribe right now. The next video after this one covers something most people figure out 10 years too late, and it drops Wednesday. But let's get back to the video. Mistake number 2, investing in individual stocks first. I get why people do this. Picking stocks feels exciting and it feels like investing, but overall the data says otherwise. And we covered that in the last video. Over any 15-year period, more than 90% of professional fund managers with unlimited research sources underperform a simple index fund. You're not going to outperform them by picking your favorite stocks on a phone. Index funds first, individual stocks, if ever, much later. With money you can afford to lose. Mistake number 3, waiting for the right time. There is no right time. Vanguard's research across nearly a century of market data found that lump sum investing outperformed waiting in roughly 75% of scenarios. The market is always at a high. It is always at the wrong moment until 20 years later when it's the obvious right moment and you wish you started earlier. Time in the market beats timing the market. Every time the data has been run, that statement holds. I know it's cliche, but believe me, it is so true. Get in there. So you have $1,000. Your emergency fund is handled. Now what? 2 scenarios. 1 clear answer for each. Scenario 1, you don't have a Roth IRA yet. Open one. Put the $1,000 there first. As we covered in the Roth IRA video, this account gives your money tax-free growth for decades. The same $1,000 inside a Roth IRA versus a taxable account is not the same investment over 40 years. Inside the Roth, you keep everything. Outside the Roth, the government takes their cut every single year. If your income is under $153,000 as a single filer in 2026, you are eligible. Open the Roth first. Scenario 2, you already have a Roth IRA. Great. You have 2 options. Option A, contribute more to the Roth. The current 2026 limit is $7,500 per year. If you haven't hit that yet, add to it. Option B, open a taxable brokerage account. If you maxed out the Roth, a regular brokerage account at Fidelity, Vanguard, Schwab, Robinhood, whatever, lets you invest without the annual cap. Either way, the $1,000 goes into one of these two accounts. Not a savings account, not crypto, not individual stocks, one of these two accounts. Here's the question that paralyzes most new investors. Do I put all $1,000 in at once, or do I spread it out over a few months to avoid buying at the wrong time? Well, the data has a clear answer. Investing a lump sum beats spreading it out in approximately 75% of historical scenarios. The reason is simple. Markets go up more often than they go down, and when you spread your investment over several months, you're statistically more likely to be buying at a higher price later, not a lower price. Every week your money sits in cash is a week you're missing potential growth. So for most people, put the $1,000 in at once. The exception, if you're genuinely anxious about investing a lump sum and you know the anxiety might cause you to panic sell the moment the market dips, then spread it. Spread that $1,000. 6 monthly contributions of $167. Not because it's mathematically better, but because the best investment strategy is the one you actually stick with. An investor who stays in the market through a 30% correction wins over the long run. An investor who panics and sells at the bottom loses every time. Pick the strategy that keeps you in the market. That matters way more than the entry point. This is where most finance content fails you. You get the explanation, you get the philosophy, and then nobody tells you what to press. Well, not today. Here are the exact funds by platform, verified expense ratios, no vague recommendations. If you're at Fidelity, we went over this in the IRA video, FZROX, Fidelity Zero Total Market Index Fund with a 0.00% expense ratio, minimum investment $1. This is the most beginner-friendly starting point on the list. Zero fees means every dollar you put in works for you immediately. Nothing taken out before compounding begins. VOO, 0.03% expense ratio, minimum of $1 buy-in. VTI, Vanguard Total Stock Market ETF, expense ratio 0.03%, minimum buy-in $1. Both are excellent, both have identical fees. VOO is the S&P 500. VTI adds mid and small cap companies. For a beginner, pick one and start. SCHB, expense ratio 0.03%, minimum $1 singular dollar. The one decision system, pick your platform, open your Roth IRA, buy one of these funds with your $1,000, turn on automatic monthly contributions, turn on dividend reinvestment, also called DRIP, and then leave it alone. This is the entire system. Some of you might want to use Robinhood. Robinhood is a little bit more beginner friendly. If you guys want to use Robinhood, please feel free. That's how I started. I do have a referral link in the description. Get you started out with some free stock. I get free stock. You get free stock. Everybody wins. If you want to automate your investing, Acorns, you simply set an amount that you want contributing, whether it's weekly, bi-weekly, monthly. Acorns is super easy. You pick a dollar amount and it does all the heavy lifting for you. It auto invests based on your risk profile that you get to choose. I love Acorns. Both links are in the description if you want them, but both work. Both are real entry points. Pick the one that gets you started today. Here's a step most people skip after making their first investment. They put $1,000 in, they feel good about it, and they don't add anything. The $1,000 compounds, but they never build on it. The single most powerful move after your first investment is setting up automatic contributions. And here's why this changes everything. The average person doesn't invest consistently because they wait to see if they have money left over at the end of the month. And that's reasonable, but there's never money left over at the end of the month. Automating flips that. Set a reoccurring transfer for the day after payday, even $50 a month, even $25 a month. It moves before you can spend it. And here's what consistent monthly contributions do to your portfolio over time. $50 a month added to your $1,000 starting investment at a 10% annual return over 30 years grows to approximately $113,000. Not from being lucky, not from picking the right stocks, from $50 a month in patience. Set the automation today. Before you close this video, this is the move. One question for the comments. Where are you starting? Fidelity, Vanguard, Schwab, Robinhood, Acorns, whatever it is. Let me know. Drop it below. I read every single comment and I'm building the next video in this series around your answers. Here's what you now have. You know why investing matters. You know what a Roth IRA is and how to open one. You know what index funds are and why they they win, and you know exactly what to do with your first $1,000. That's a complete system. The next video in this series covers one of the most asked questions in the comments across all 4 videos. Roth IRA versus 401k. Which one do you use first? And what happens when you have both? And the one mistake that costs people hundreds of thousands of dollars. That video drops next Wednesday. Subscribe so you don't miss it. And if this series has been valuable to you, send this video to someone who has $1,000 sitting in a savings account right now with no idea what to do with it. That's who this video was made for. I'll see you guys Wednesday.